Yo, I ain't here for the money, I ain't here for the fame. Though it might be nice to own a jet plane, I'ma do it all for you.
Fellow investors, welcome back to our channel, where we bring you the latest updates and insights on the stock market. Today, we have an important topic to discuss: the role of the consumer in shaping the economy and its impact on the stock market, followed by debt-selling talks, economic events this week and some earnings that we will be watching. Let's do a quick recap of last week. The path ahead for the economy relies heavily on consumer spending, which accounts for a significant 70% of the US GDP. While consumers have shown resilience lately, recent data suggests that they may be starting to feel the strain. As we anticipate a gradual slowdown in consumer spending this year, it's important to understand the implications for the stock market. Despite unemployment being at a 50-year low and wage growth remaining healthy, there are signs of softening employment conditions. While we maintain a base case outlook of a mild recession this year, we believe it won't resemble previous recessions due to a better prepared consumer. This means that even if a recession does occur, it may not lead to new lows for equities, as the stock market's lows from last October have likely already priced in a significant portion of this outcome. So, how does this all tie together? Let's take a closer look at the three key takeaways from the recent data and observations. The first key takeaway is that consumers are showing some initial signs of fatigue. While consumer spending has been strong, with a robust start to 2023, there are indications that consumers' enthusiasm is starting to wane. Retail sales in April grew at a slower than expected pace, with lower gasoline sales and weakness in sporting goods and home furnishings. However, it's important to note that April retail sales were still up overall, suggesting that consumers are becoming more discerning rather than completely retrenching. We're particularly paying attention to services spending as a gauge of consumer enthusiasm. While the growth rate of services spending is slowing, it remains above average. This moderation is necessary for our outlook of a mild slowdown, as it will enable the Federal Reserve to ease up on interest rate hikes. In summary, consumers may be getting a bit winded, but we anticipate a gradual slowdown in household consumption rather than a drastic plunge. The second key takeaway revolves around the labor market. Historically, a tight labor market has supported consumer demand, but it has also slowed down inflation. However, there are signs of modest softening in employment conditions. While initial jobless claims have risen from the lows of last September, they remain historically low. This indicates that consumers are entering this economic shift from a position of strength. We're also seeing some improvement in continuing jobless claims, which suggests a possible return to the workforce. Slower hiring, layoff announcements, and moderating wage growth are expected this year. However, as long as unemployment remains relatively low, we believe employment trends will provide more support than harm to the consumer and the economy. Lastly, we discuss the possibility of an atypical recession. Previous economic downturns often saw significant weakness in personal consumption, fueled by consumer deleveraging and high household debt. However, the current scenario is different. Household debt service burdens are lower than in past cycles, and the overall health of the consumer and labor market is better positioned. Comparisons can be drawn with the 2001 recession, where business spending dropped, but household consumption only experienced a slowdown rather than a sharp contraction. We believe this year's recession, if it occurs, will have a more mild complexion compared to previous recessions. The stock market's lows from last October have already factored in a significant portion of this outcome, which means that even if a recession does materialize, it doesn't necessarily have to result in new lows for equities. While there are concerns and uncertainties in the market, it's important to remember that the economy's performance is closely tied to consumer behavior. With consumers accounting for over 2/3 of the US GDP, their income and attitude play a pivotal role in shaping economic trends. Now let's take a look what's on the calendar for this week. Investors can anticipate an eventful week ahead as it brings forth a combination of key factors that are poised to impact the financial landscape. Firstly, the ongoing deliberations surrounding the debt ceiling will continue to capture attention. House Speaker Kevin McCarthy recently stated that discussions on the debt ceiling would recommence once President Biden returns from his participation in the G7 meeting in Japan. President Biden, before departing for the G7, expressed his dissatisfaction with the GOP's stance on the debt ceiling, deeming it unacceptable, and urging the other side to move away from their extreme positions. This issue gains greater significance as Treasury Secretary Janet Yellen's June 1 ex-date, which marks a critical deadline for the Treasury's ability to fulfill its financial obligations, approaches. In addition to the debt ceiling concerns, investors will closely monitor the release of retail earnings in the minutes from the Federal Reserve's latest meeting. Notable retail giants such as Dollar General, Costco, BJ's are set to unveil their financial results, providing valuable insights into consumer behavior and the impact of inflation on household budgets. Walmart's earnings hinted at the trend of affluent consumers opting for more cost-effective options, contributing to the performance of certain retailers. The earnings report from Nvidia and Snowflake, a prominent technology company, is also highly anticipated as it has experienced significant stock growth this year. Furthermore, economic data releases will offer further guidance on the Federal Reserve's future trajectory. Investors will scrutinize these indicators for any hints about the central bank's approach to interest rates, especially considering the conclusion of its aggressive rate hiking campaign. Thursday's release of the second estimate of first-quarter GDP will shed light on economic growth during that period, while the Personal Consumption Expenditures (PCE) price index for Q1 will serve as an important gauge of inflation. Economists predict that core PCE, excluding food and energy costs, remained unchanged from the initial reading, and April's figures are also expected to show stability. While these factors dominate the market's attention, the specter of the debt ceiling looms large. Historically, the approaching X date has heightened market volatility, particularly in the 2 weeks leading up to it. The possibility of default weighs heavily on market sentiment. UBS's Global Economics and Strategy team outlined potential scenarios, noting that if the X date is crossed without a formal default, a drop of 5% to 3,750 may occur but prove temporary. However, a week-long non-payment of coupons or a month-long non-payment would have more severe consequences, resulting in a drop of up to 20% or even 30% in stocks, respectively. Despite the uncertainties surrounding the debt ceiling and the mixed signals from the retail sector, stocks closed the previous week with gains, with the Nasdaq experiencing its best week since March and the highest weekly close since August 2022. The year-to-date performance of the Nasdaq has exceeded 20%, while the S&P 500 has risen over 9%. However, the Dow Jones Industrial Average is barely maintaining its gains for the year. As the new week unfolds, investors will closely monitor these key events and data releases, which are poised to shape market sentiment and potentially influence the trajectory of various asset classes. That's all for today, folks. We hope this analysis has shed some light on the current state of the consumer and its potential impact on the economy and stock market. As always, make sure to stay informed and conduct your own research before making any investment decisions. If you found this video helpful, don't forget to like, subscribe, and hit that notification bell to stay updated with our future market insights. And remember, invest wisely and keep an eye on consumer trends.